Welcome to Taking Stock for the week ending the 19th of November 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to your thing share market. Welcome once again, Jake.
Thanks, Kien, and really looking forward to today's discussion.
Well, markets have been uneventful over the week, so today we want to focus on the upcoming enhancements to Stock Doctor, which will be rolled out early next week. As many of you know, our Stock Doctor methodology has been built on Dr. Merv Lincoln's PhD thesis in 1982, titled The Usefulness of Accounting Ratios to Describe Levels of Insolvency Risk. Over time, Tim Lincoln, his son and co-founder, has integrated this research into our Stock Doctor platform to empower our members to invest with confidence, control, and peace of mind. But this is never a finished project. As markets and technology evolve, we continue to innovate and invest in research and development to improve on Stock Doctor. In phase 1, we rolled out our optimized style growth stock strategy, and this has begun to show potential with strong returns to date. Today, we want to highlight phase 2, our enhancement to the Stock Doctor platform and user experience on the back of our optimized style growth stock model. Firstly, we've added an additional factor called 3 months earnings revisions under Golden Rule 3 outlook and active risks. Our backtests have revealed that this factor can contribute to stock selection that exhibits excess returns above the market. In other words, investors can enhance their portfolio returns if they avoid investing in stocks with negative forecast earnings revisions. This is a powerful factor to help you invest in the facts. We have also incorporated this factor into our filters and watchlist tools. In addition, you can also set up earnings change notifications under the Alert Manager to inform you if the forecast earnings revisions have turned quite negative.
And another key change is that the Lincoln valuations will be replaced with consensus price targets. Our Lincoln valuations tend to be updated less regularly than consensus, and disparities between our valuation and consensus can cause confusion amongst investors. By only displaying consensus valuations, we'll be leveraging on the expertise of leading global research houses and allow our research team to focus on what they do best, optimizing our quantitative methodology and assessing the active risks of a business.
That's right, Jake. And there are also the valuation multiples like PE and PEG ratios for you to use if you wish. And another enhancement is the portfolio manager. Now it can be tailored to trend-sensitive investors, specifically when you set up a portfolio profile. Members can choose the SD Max, which is the Stock Doctor moving average crossover, if they are highly trend-sensitive, or the SD30 TSR, which is the 30% stop loss from highs or lows if they are moderately trend-sensitive. And those who select these options will not be recommended any stocks that are trading in a bearish trend or have triggered an exit. There are also a few other enhancements, including having intuitive headings in the Analyst Updates section and the Daily Digest, but we'll run through these in our upcoming information webinar at the end of the month.
That's right, Kien. Now moving on to our star stock highlights for the week. Leading Big Four lender Commonwealth Bank released its first quarter FY22 trading update, but was sold down heavily on the day. The main driver of this was due to comments around its net interest margins, and that's the difference between what it receives on loan rates and deposit rates, which was considerably lower over the quarter as it battled headwinds including lower yielding cash and bond rates, strong competition, and high proportion of low fixed rate loans on its books. Its net interest margin was at 2.04% at the end of June, but is now expected to move more in line with peers at below 2%. Although this would likely lead to negative earnings revisions under Golden Rule 3, active risks and outlook, we believe that the bank's forward dividend yield at 5.7% remains sustainable due to its unstretched payout ratio of around 75%. Hence, any further share price weakness could represent opportunities for investors to gain exposure to a high-quality Australian bank, which has experienced above industry growth across its mortgage and business loans.
And meanwhile, Jake, during the week, casino and online gaming company Aristocrat's financial year 21 result was well flagged and therefore did not present a surprise. Performance over the year was robust with land-based casino sales up 9%, while its digital segment gained to 5% at the top line, and the digital now represents about 51% of group sales. Management did not provide quantitative guidance for financial year 22, but noticed sustainable growth in the sales of pokies machines and digital gaming, and this should help the company achieve its high double-digit growth for the year ahead. But of course, the acquisition of the global online gaming group Playtech was not reflected in the latest accounts as the deal has not yet been closed. However, if the acquisition takes place, the significant rise in debt could potentially weaken the financial health of the business, which is already trading at elevated balance sheet ratios, especially with the total liabilities to total tangible assets. But we will be monitoring future developments relating to the Playtech acquisition, especially given that Gopher Investments may also make a counter offer for Playtech. Should the transaction proceed with Aristocrat, then the group could potentially fail financial health in 6 months.
Now, turning our attention to the week ahead, Technology One will be reporting their annual result on the 23rd of November, while Fisher & Paykel Healthcare reports its interim result on the 25th of November. There'll also be a handful of companies providing trading updates as we reach the tail end of the AGM season. However, no stocks will be going ex-dividend next week. Now moving to technical alerts, investors who are trend sensitive can use the SD Max, which is the Stock Doctor moving average crossover, or the SD30 TSR, the 30% stop loss or gain from highs or lows. For the highly trend sensitive investors, we had several bullish SD Max signals this week, starting with ASX Limited and Newcrest Mining. Meanwhile, Mass Group and Waypoint REIT turned bearish on the SD Max. No signals were observed on the SD30 TSR.
Today we want to focus on star income stock, power and gas distributor AusNet Services, because it's currently under takeover by Canadian asset manager Brookfield for $2.65 per share. The deal has received a tick of approval from the Foreign Investment Review Board, and shareholders will now get to vote on the offer, with this likely to occur early in the new year. Interestingly, AusNet posted a drop in earnings and operational cash flow for the first half, which was driven by softer revenues and a higher capital expenditure linked to reconstruction costs from the Melbourne storm in June, and also planning costs for the Western Victorian Transmission Project.
That's right, Kien. And the drop in revenue was due to lower yields from its regulated asset base of electricity distribution assets, which was reset by the Australian Energy Regulator in April 2021. A reset occurs once every 5 years and governs how much the company can charge for electricity to consumers. It also dictates how much investment can be made in the network. Despite this, the company was able to retain its dividend guidance, expecting to pay 9.5 cents per share for the year ahead should the acquisition by Brookfield not go ahead. Currently, consensus is anticipating a slightly higher dividend payment over the next year due to the significant operating cash flow margin it has on dividend payments. Hence, we expect a gross dividend yield of above 4%, which includes the impact of a takeover premium, to be realistic.
However, due to the timing of the expected shareholder vote, it is unlikely that shareholders will see the second half dividend. Instead, they will receive the $2.60 per share cash payment, which excludes the interim dividend. Therefore, prudent income investors may wish to think about a potential replacement for this defensive utility company.
That's right. And the closest comparable business is gas pipeline distribution company APA, which has a gross dividend yield of around 5.8% and has recently focused on increasing its exposure to renewables. Investors also may look towards defensive telecommunications businesses like Spark New Zealand and Telstra, with dividend yields of around 5.5%. Meanwhile, property trusts like Waypoint, Charter Hall Long Whale, BWP Trust, Charter Hall Social Infrastructure, and rural funds offer attractive opportunities in businesses with large asset bases that deliver steady dividend streams.
One of the enhancements to our Stock Doctor platform is the introduction of forecast earnings revisions to Golden Rule 3, Outlook and Active Risks. So a pertinent question for investors this week is, why is earnings revisions an important factor in our qualitative assessment of star stocks? Now, brokers and research houses they usually have analysts who cover listed companies and provide an estimate on the company's forward earnings. The consensus earnings estimate is the median forecast estimate provided by these research analysts.
Earnings revisions is a momentum factor that measures the change in the consensus forecast earnings over time. Changes to earnings estimates reflect changes to the company's anticipated future performance, mostly driven by unexpected trading updates or earnings results. Our research and others have indicated that a strategy of selecting stocks with the highest earnings revisions or avoid those with the worst revisions over 3 months can generate above market risk adjusted returns.
As you can see from the chart on screen, a portfolio invested in the top quintile in earnings revisions shown in the maroon color would outperform a universe of stocks significantly as shown by the blue line. In the chart, we've also shown a portfolio of only financially healthy businesses in green, and this subset also adds value when compared to the entire universe of stocks. But now members may be wondering why we didn't incorporate earnings revisions fully into our quantitative star stock selection process if the factor performs so well.
Well, Kien, the reason for this is because earnings revisions can lead to high portfolio turnover because changes to the forecast earnings can occur on a daily basis. Hence, it makes more sense for us to include it in Golden Rule 3, the outlook and active risks, as part of our qualitative assessment so we can decipher whether an earnings revision is significant enough to warrant inclusion or exclusion from our star portfolios.
That makes sense, Jake. And of course, you can generate a list of stocks with positive earnings revisions or a set of alerts for stocks that have large negative earnings revisions as well. But that's all we have time for. Thanks, Jake, again for your insights today.
Thanks for having me on again, Kien.
So at Lincoln, we will always continue to innovate, invest in research and development to enhance the Stock Doctor experience for our members. This will mean that on Sunday, the 21st of November, we'll be implementing these changes to the Stock Doctor platform so this system may be unavailable between 10 a.m. and 2 p.m. on this day. We'll also be releasing updates to our 3 white papers starting next week. What is the star stock? The importance of financial health and our 9 golden rules. Also on Monday, we'll be sending an email to highlight these improvements. And members will be able to register for our exclusive webinar with Tim Lincoln at the end of the month for more details on these enhancements. In the meantime, stay safe and have a happy, healthy and prosperous week, everyone.